Thanks for clicking! The Canadian Real Estate Association, the CREA, has released Canada's national real estate data for the month of March, showing a real estate market that is stalling.
No, it's not!
Indeed, not to be deterred by its own data, the CREA is continuing with its forecast of price increases, noting that things could get interesting. And, as we'll see today, while there is a market disconnect between the CREA's forecast and its own data, thankfully we have CREA economist Sean Cathcart to set things straight.
The man you want to hear from, CREA senior economist Sean Cathcart.
Speaking of data interpretation, the media is also predictably enamored with another report making the rounds, just released by LePage, which predicts that home prices could rise by as much as 9% this year. Given the extent to which this report is making the rounds, I think it's worth delving into that data as well. So what I want to do today is go over the real estate data coming from the CREA, take a look at its interview with world-renowned economist Sean Cathcart, go over the report from LePage, and then discuss some implications for Canada's real estate market going into the spring. Speaking of implications for the spring market, Stats Canada is set to release Canada's inflation data for the month of March tomorrow, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home that represents the most popular set of features, and the price to which the CREA was so enamored when it stopped falling in February. It's falling again, though not by much, down 0.3% to $718,400, down from February's $720,500. So that's about a $2,000 drop in the benchmark price in March, and the benchmark is still up about $8,000 since this point in time last year, when it was sitting at $710,400, back when LePage told us to expect a 4.5% increase in prices by the end of the year.
That guy's a genius!
And some of the decrease in the benchmark price could be due to a lack of demand, as sales were only up 0.5% since February. The CREA says that new listings were down 1.6% since February, though we'll have to take their word for that, as the CREA doesn't provide monthly new listings data, only providing quarterly annualized data for new listings, for whatever reason.
You don't need to know everything.
With that said, using that data, we can see that quarterly annualized new listings are up fairly substantially from this point in time last year, up 16%. And the CREA's economist Sean Cathcart actually summarized the month fairly well, noting that there was nothing really to write home about.
Sales in March were flat, up 0.5%. New listings were down 1.6%. Prices dipped 0.3%. Again, not that much to write home about.
And yeah, that makes sense. No major increases in sales, no major increases in listings. The benchmark price fell, though not by very much. Nothing really big coming out of the national stats. And then came the reversion.
Not that much to write home about, but it's what you might call a shoulder month. One of these. It looks like not that much is happening, but we are really starting to turn a corner.
What's this?
The greatest economist who ever lived.
Now, Cathcart doesn't elaborate what this means, but I think he's referring to something like this, assuming we're in a trough period right now, before a bullish move upward to a new high. But, like I said, I can't say for sure. Cathcart doesn't elaborate. In fact, Cathcart doesn't really explain at all, or give anything to indicate why we're about to turn a corner, simply moving on to what happens when that corner is turned.
Looking like the market is really gearing up. We saw bursts of new listings in mid-March, followed by a surge in sales in the last week of the month, right before the long weekend, and then everything dies down. But more recently, we saw a huge jump in new supply in the first week of April. So the question now, and that we've been asking for a while, is will the story be high interest rates keeping people on the sidelines early this year? Or is it the much expected and anticipated first cuts?
Which you can't just skip to the effects of the conclusion without discussing the thing that caused the conclusion in the first place. What is the indicator that says we are about to turn a corner? Is it that the sales to new listings ratio is at its lowest point for the month of March since 2019, meaning that buyers for the month of March have the most power that they've had for 5 years? Is it that demand or sales is marginally higher than it was a year ago, but still right around where it was pre-pandemic? Or is it because bond yields were on an upward trajectory, sending mortgage rates upward, even despite the Bank of Canada saying it was going to cut? Or is it the rising unemployment and worsening economy?
To name a few.
Well, Cathcart doesn't say, only saying that although listings are up, we're about to see if buyers are going to return to the market.
As of right now, the listings are finally out, so we'll see how the buyers respond in the next month's data.
It's a slam dunk.
So, next month's data may show that we're about to turn a corner. Cathcart's right on that, it definitely could, but there's nothing really in this month's data to support that argument. So, we have the benchmark price down, though marginally, in March, though that really isn't out of the ordinary. Sales are up, though very, very minorly. Listings are also up, though we're not sure by how much. And the market, at least in March, was more in the favor of the buyer than it's been since 2019. Cathcart was indeed right that there's nothing to write home about in the March data. The only issue lies in drawing conclusions from data of which there is nothing to write home about. Speaking of data issues, Royal LePage, which, as mentioned, is making national headlines for its forecast that home prices could rise by as much as 10% over the next year. Now, not far into reading this release,
Why would you do that?
I noticed that the report says the aggregate price of a home in Canada had increased year over year by 4.3% to $812,000. Yet, we know from the CREA's own data that the first quarter benchmark price in 2024 was $719,000, up from the previous year's $712K, a 1.03% difference. And when you see inconsistencies this large, you want to go directly to footnotes. And there we find that LePage is getting these prices by using a weighted average of median values across all housing prices, using data compiled by RPS Property Solutions and Royal LePage Regional Experts. Regional Experts? How is that a data set? Regardless, Royal LePage is talking about median prices, which in and of itself is a little odd, as we usually talk about benchmark prices when looking at national sales data, or at the very least average. Regardless, Royal LePage is free to do as it pleases. It's Royal LePage's data.
Whatever, I do what I want.
But it's our job to double check the accuracy. Well, technically it's the media's job, but they're not going to do it, evidently. So let's dive in. Let's take a brief look at London, where in the first quarter of 2023, Royal LePage says its median price was $682,500, which went up to $699,600 in Q1 of 2024, a 2.5% increase from a year ago. Now let's compare that to LSTAR's data, the London and St. Thomas Association of Realtors, which should, in theory, have more accurate data than Royal LePage's regional experts. London's Q1 median price in 2023 was $603K, compared with $586K in March of this year. That's an almost 3% quarterly loss compared with the 2.5% quarterly gain as reported by Royal LePage. It's fine, I guess, that Royal LePage's index shows consistently higher prices than those which are being reported by the local boards, so long as it's consistent. And we know Royal LePage has a flair for consistency. But when said indexes get directionality wrong, whether or not prices are moving up or down, then that's a real problem, as that's really all we want to know. What direction are prices moving?
Always up, always ebullient.
Speaking of consistency, in the report, CEO Phil Soper says that we're rapidly moving from that of a buyer's market to one where the seller has the upper hand. But is that the case? As we just saw, the sales to new listing ratio is at its lowest point it's been in March since 2019. In other places like Toronto, which has a big effect on aggregate data, the SNLR is at its lowest point it's been in March for the past 10 years. Moving further into the forecast, Soper also doesn't see any problems with the upcoming mortgage renewals and says that they won't provide any drag on the housing market. As even with the high rates over the past few years, Canadians have continued to meet their obligations. You mean with the unemployment rate, except for 1 month in 2019 at its lowest point in 50 years, Canadians continue to pay their bills?
Shocking.
Further, the report completely ignores the fact that mortgage delinquencies are in fact rising. And finally, interest rates. The report says that the primary driver of prices will not be interest rates, but a lack of supply. Apparently, even with the data that we've seen over the past few years, we still haven't learned that the ability to afford a thing has more of an impact on its price than the supply of that thing. If there's one house listed for $1 million and 500 people that want it and they only make $10,000, it's not selling at $1 million.
I can make it happen.
So, we have the CREA correctly pointing out that March's real estate data wasn't really anything about which to write home, but also forecasting price increases going forward. We have LePage, whose dataset is being compiled at least in part by regional experts, and that dataset isn't exactly matching the data coming from the local boards. It isn't matching what's already happened, and then making forecasts that are ignoring things that are happening right now. With all of that said, that doesn't mean that prices aren't going to go up. With the Bank of Canada signaling a rate cut in June, though that's definitely not set in stone, time will tell whether or not buyers take that as a signal, as it's time to front-run the central bank. Now that we finally have a concrete indication from the central bank that there maybe possibly could be a rate cut, it's not as ridiculous to believe rate cuts are coming as it was for the past 2 years. It's time to see how buyers will respond. As such, April's data is going to be key. April will be the first month of data that we get, where the Bank of Canada has signaled that there could be rate cuts coming to a theater near us sometime soon. With that said, we'll obviously continue to track Canada's real estate data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.